p.m. in New York, it is 7 p.m. in London. Live from Bloomberg's World Headquarters, this is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs.
And the record run continues to December. Global and U.S. stocks rebounding from Monday's retreat, with the S&P and Nasdaq up over 1%. Hopes for stimulus, hopes for a vaccine, hoping that we, of course, can continue at these high levels. Meanwhile, Powell issues his latest warnings to lawmakers. The Fed chair cautioning that the U.S. economy is still in a damaged and uncertain state. That's despite the promising vaccine news, while a group of bipartisan senators try to break the gridlock on stimulus. And we're waiting for consensus. Oil sinking as OPEC Plus ministers struggle to reach a deal on production. That's while energy giant Exxon reels from this year's collapse in prices, facing its biggest write-down in its modern history. All that and so much more coming up, Romaine.
All right, well, what a way to kick off the month of December here. Kind of picking up where we left off, I guess, for the most part for November. Rally right now back near the record highs for a good portion of the indices and a good portion of the stocks out there. Target today trading at a record high. A lot of names in the pharmaceutical space also near or at record highs at the moment. Right now, the S&P 500 up 1.5%. The Russell 2000 also seeing that cyclical rotation, being the beneficiary of that. Dollar weakness, that of course will be the story going forward should that reflation trade play out as investors think it would. And wow, Taylor, take a look at that 10-year yield right now. 93 basis points. Is the reflation trade back?
1%.
Is this it?
This is it.
Call Jeff Gundlach.
When do we start yield curve control, not let that thing go above 1% to help fund our deficit? In the meantime, let's take a look at some of the economic data that we got this morning. On a much more serious note, of course, manufacturing ISM numbers falling to a 57.5 from a 59.3. Chris Ruppke over at MUFG saying, remember, manufacturing workers still account for about 10% of private payroll employment. So this is a very worrying sign, of course, as we look to win in this economy in 2021. But that is not stopping the equity markets, Caroline. Take a look at this terminal. Matt Maley over at Miller Tabak. We spoke with him yesterday, talking about if you see a significant move above 3,600, clearly maybe his 3,800 price target could be too low. The next stop up, and I stole this from our chartress, Abigail Doolittle, 3,900 plus could be the next leg up. Caroline?
Will we get there? The key question. Let's ask Tracie McMillion, who's with us, head of global asset allocation strategy at Wells Fargo Investment Institute from Winston-Salem. Wonderful to have you with North Carolina joining us. Talk to us, Tracie, about whether or not we get to that level. Is it time to still be allocating to equities?
Yes, actually, it is time to still be allocated to equities. Granted, we had a great November, one of the best months in decades, and we looked back at other periods where we had such strong performance in a 1 month period. And what we found was that since World War II, the month after averaged about a 1% gain. And 6 months after averaged about a 13.5% gain. 12 months was over 15%. So typically when we have such strong gains, it's indicative of good things that are happening to support the markets.
Yeah, and right now, I mean, the stars seem to be aligning here, Tracie, for that support to continue, if not directly from the government in some way. There is a general theory out there that household savings and, of course, a rebound in the economy might be enough to continue to fuel some of the market gains here. Are there any sort of roadblocks that you see up ahead that give you any sort of concern?
Sure. Well, there are always the headwinds and the tailwinds that we have to consider. And some of those potential roadblocks are that we could potentially not get the type of fiscal stimulus that the markets are looking for. It may be after the inauguration before we get it, and we may have expiring benefits at the end of this year. There's also the government funding on December the 11th that could be a more near-term roadblock if that were not passed. And then, of course, we have COVID cases rising, and the vaccine rollout is scheduled to start later this month, which is terrific news, but we don't know exactly how long it's going to take for that rollout to be to the extent where the economy can resume more normal activity again.
Tracie, do you think asset allocation, does 93 basis points on a 10-year get your attention as an attractive entry point?
Not really. In fact, we're still looking for some potentially higher yields in 2021. So we think maybe 1 to 1.5% on the 10-year. So maybe a little bit more yield in the offing in the coming year. And compared to our targets for equities, that 1% yield, 93 basis points is just really not very attractive. In fixed income, we'd be looking at opportunity to maybe go down a little bit in credit quality and increase the yield potential, increase the return potential. And I do have to say, as an asset allocator, that you do want some of your assets in those safer type bonds, but the amount really depends on your risk tolerance. But we're still more favorable equities.
Do you want your assets in gold anymore, Tracie?
We do. In fact, we like commodities as a group, and certainly gold is a big part of that allocation. And we are looking for gold to probably be in the 2,000-2,100 range, maybe by the end of next year. And we think gold will benefit from these low interest rates and in some ways act as a hedge within a portfolio like your traditional fixed income would.
And with regards to the rest of the commodity space, Tracie, I mean, a lot of attention not only being paid right now to gold, but of course the industrial metals and sort of what that may mean or not mean for the economy. How much are you reading into the moves that we've seen in copper, palladium, platinum, et cetera?
Yeah, so certainly that's an indication that investors are thinking that there's the global economy is going to be moving or be growing more from this point forward. And we do like the industrial metals, we like gold. And in terms of oil, that's another aspect of global growth. That oil prices could also rise in the coming year, even though we may see some near-term oversupply. So, the demand may actually increase faster than many investors are thinking.
All right, Tracie, always great to have you. Always great to get your thoughts. Be well. Tracie McMillion, head of global asset allocation strategy over at Wells Fargo Investment Institute. Now, a lot more coming up here. The challenges ahead. We're going to talk about why Fed Chair Jay Powell says the next few months could be concerning, even amid the positive vaccine news. Plus, that historic write-down, why Exxon is about to incur the biggest one in the company's modern history. We're going to discuss what that means for the broader sector. And most people, well, they got rid of their BlackBerrys a long time ago. BlackBerry shares rallying today by the most since 2003, and it may all be because of Taylor Riggs. We're going to explain when we come back. This is Bloomberg.
Early this morning, we heard some testimony from Fed Chair Jay Powell, along with Treasury Secretary Steve Mnuchin. A lot of questions about some of the stimulus programs and the expiration of those. And I wanted to highlight, of course, deficit to GDP, the percent of that, now up to about 15%. I want to bring in our Bloomberg International Economics and Policy correspondent, Mike McKee. Mike, any talk yet of how we think one day we'll pay for this all, or clearly no, we just need more money and we need it more quickly?
Well, no serious talk about it. And Jay Powell, Janet Yellen, the incoming Treasury Secretary, and others have said this is not the time to worry about the costs. We should do what we need to for the economy and figure it out later. However, given that Republicans will soon be in the opposition, they seem to be adopting a bit of the old deficit hawkery that they used to say. And so we may see more of that going forward. Instead, most of this hearing was about, as you mentioned, the programs that Treasury Secretary Mnuchin is suspending, the Fed lending programs, and whether that's a good or a bad idea. And again, to go back to politics, Republicans generally thought it a good idea. Democrats thought it a bad idea. Jay Powell didn't have much to do today except repeat that he thought that the economy was slowing down. We have a difficult time ahead of us, and perhaps we should have more fiscal help.
Yeah, kind of interesting how he's become the least important person in the room these days. I am curious about the fight, or whatever you want to call it, between the Treasury and the Fed over that remaining money. And we heard from Mnuchin, who basically kind of made it clear that he wanted that money in Congress's hands and not necessarily in the next president's hands. What exactly is he aiming for?
Well, we don't really know. He says that he's doing what the law requires. Many of the Democrats said, no, that's not what the law requires. Others say that the Treasury Secretary just wants to hamstring the incoming Democratic administration. The point is this is a big fight over who's right about what stimulus we might need, but doesn't really matter because at this point, none of it's being used. The Fed's point is if we have it there, then people feel confident that it will remain and that we will be the backstop. But no, we haven't had to use a whole lot of it. We might in the future, but we might not. And there is money in the Exchange Stabilization Fund at Treasury that they could call on if they needed to in the short run. So this is probably one of those things that will blow over, just sort of a symbolism of the battle between the Republicans and the Democrats as we get ready to see a change in power.
Talk to us about that change in power, the economic battle guard being drawn up, it would seem, by Biden being unveiled. We heard from Yellen, we heard from many others today.
And their focus is on what the president-elect made sort of the centerpiece of his economics, and that is to help out the underprivileged and those who have been left behind. He's not going to probably be able to raise taxes on the rich unless the Democrats take the Senate with those Georgia races, but they can target aid and they can target relief programs to people at the lower end of the income spectrum, and that's what we heard from Janet Yellen and others today as Biden introduced his economic team.
We want to thank you, Mike McKee, all over the various current Treasury Secretaries and future Treasury Secretaries. Michael McKee, thank you. Now coming up, is Milton Friedman wrong? And if so, how wrong? One Harvard professor wants to revolutionize the way corporations calculate their success, stressing ESG over shareholder value. We discuss this is Bloomberg.
You know, here on this program, when we think about the top and the bottom line, you typically discuss corporate profits and how it relates to shareholder value. An interesting take. We had a story today. Harvard Business School professor is trying to put a dollar value now on the impact that businesses have on people and the planet, how that impacts how you measure the bottom line. And this is difficult, Romaine, because there's no consensus on how to value this, how to put a dollar value on this. How does this actually impact the bottom line? Here, of course, is a chart showing ESG in white relative to world stocks in blue. And while they trade in tandem, ESG has been one simple way that we've tried to measure this. But this new research shows that maybe there is going to start to be a new way to actually finally value the impact of ESG and the impact on the bottom line.
Yeah, and this is a really interesting debate because this really gets to the fundamentals of our economy and really the fundamentals of the market as well. Someone who's been tracking this for quite a few years is Peter Coy, who's our economics editor over at Bloomberg Business Week, and he's joining us right now to talk a little bit more about this. Peter, let's start off with kind of the foundation of sort of how we got to where we are today. The sort of Friedman economics. Right. I think we just, the 50-year anniversary of that famous essay in the New York Times Magazine that shareholder value is basically all corporate CEOs need to be concerned about. It is a thesis that to a certain degree has been ridiculed as of late. And now you have these folks, including the economists that we wrote about today, who seem to have found a new way, or at least what they say is a new and better way to value companies. Was Friedman wrong in his core thesis to begin with?
Well, that's pretty controversial. I mean, I think that he made some excellent points. And I know that's not popular to say these days in this era of ESG, but in fact, it is true that as soon as you start moving away from shareholder value into stakeholder value, things get very fuzzy very quickly. So to George Serafim's credit, he's the professor at Harvard Business School that we're talking about here, he's trying to remove some of that fuzziness. He's trying to put value on the impact the companies have beyond the ones that are measured through corporate profits. So that would be anything that's in the ESG category. It could be their global warming or their treatment of workers and so on.
what gets measured gets managed, of course, is kind of
Right.
the viewpoint here. I mean, but it goes really granular. His data is sort of looking at charging credit card companies for the medical cost of, well, depression connected with indebtedness, or perhaps it's the, the flight cancellations and the mental impact that might have, or the lost time, the overall cost to you that you might suffer by going to the airport and having to wait for as long as that. I mean,
Well,
how granular really can you get, and how can you?
I was just about to get to that. I think that's an excellent point you're making, which is the world is a very complicated place. And you can't really do this exercise without getting granular, because there are so many ways companies affect us in our daily lives. But the more granular you get, you're basically trying to dig into every behavior of every human being on the planet who's somehow affected in one way or another by a company, and quantifying each of those measures. It becomes completely, to me, unmanageable. And the fear to me is that corporate boards are going to pick and choose. They're going to cherry pick the ways in which all these indicators help them, and sort of ignore the ones in which they get hurt. And all that does is kind of relieve boards of their responsibility, because now they're no longer bound by the old-fashioned measure of improving their corporate profits. Now they're into ESG, and yet they're choosing the ESG framework that flatters them.
Peter, on that note, what is the willingness of companies to embrace this?
Well, you are seeing companies, we've had this term greenwashing for a long time, which is calling everything you do green and kind of putting a nice sheen over it. And now they're expanding that to the term of good washing. And so the fear is Seraphim is devoted to trying to get beyond good washing, to quantify things. But it could be that some of the companies that are claiming to embrace this are, in fact, guilty of greenwashing or good washing.
Yeah, interesting times here. A lot of interesting theories that still have to be played out. Peter, I'm going to leave it there. Peter Coy, economics editor for us over at Bloomberg Business Week. All right, let's get over to Taylor for the Business Flash headlines.
Thank you, Romaine. Starting with Tesla, they're going to be added to the S&P 500 on one shot on December 21st. It's a move that will ripple through the entire market. Money managers are going to have to adjust their portfolios to make room for a company now worth $538 billion. S&P had considered adding Tesla in two parts because of its size. It will be the 7th largest company in the index. Credit Suisse is proposing that the next chairman be the outgoing CEO of Lloyd's Banking Group, Antonio Porta Osorio. Shareholders will vote on the nomination in April. He steered Lloyd's to profitability and full private ownership after the financial crisis. Credit Suisse is trying to reverse a run of low profits. And Bank of America has bowed to opposition from environmentalists. The bank says it will not provide financing for oil and gas exploration in the Arctic. Earlier this month, the Sierra Club singled out B of A as the only major U.S. bank not to rule out lending for energy projects in the Arctic refuge. And you guys, my favorite story of the day, shares of BlackBerry. They're rising the most at one point on record, up 52%. This is a Canadian company that we remember because of the phones. But now they've signed a multi-year deal with Amazon Web Services to develop BlackBerry's intelligent vehicles platform. It will allow automakers to standardize vehicle data across all models.
Do people still use those BlackBerry phones?
Does anyone
I
here?
brought this.
Wow.
Check out this
That's like a
beautiful
relic.
keyboard.
How long ago
The
did you buy
beautiful
that?
purple shade 1 year ago to the date.
Wow.
And where does one purchase such
Yeah,
a
where do you
beautiful phone?
find this?
Amazon, blackberry.com. It's a beautiful, beautiful.
Is there like a
piece.
little underground club of the BlackBerry users? You guys get together?
IBBM. I can ping people.
Is
Really?
the operating system still like
Android.
upgraded?
Android operating system.
Well,
So
this is,
I'm bringing it
Eureka
back,
moment.
guys.
well, this is amazing. I mean, the company, of course, in all seriousness, they did really try to sort of build out that software program, the one that's at the heart of what you were just reading about. The shares, 36%, $8.
QNX.
It only has about $140 more to go to get to its all-time high.
I love this new program that they're working with AWS for the automotive industry. It's a program that they're calling IVY. An intelligent vehicle data platform. It's going to let automakers read vehicle sensor data.
Wow.
So it's basically your Amazon, it's delivery. It's all about cars not crashing into each other. But the main point here is that Taylor has still got a BlackBerry phone. And is it your own phone?
And you're not even
Only
Canadian.
phone, or do you have another one?
I do have an
Are you
an
worried about being
iPhone.
hacked? Is that the issue?
I dare China to try.
Yeah.
Oh my gosh. China, if you're listening.
Don't bait them, don't bait them. Meanwhile, all about keeping it real, keeping it old school with our, what is she, 209, what did we say?
209.
209 girl.
209.
Not supporting her local
Shouldn't have
tech
reminded me
companies.
of that.
She's going all Canadian.
We're going to be hitting that all day long.
We're still higher in the markets, guys. This is Bloomberg.
This is Bloomberg Markets to Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A lot going on in the commodity space. Let's catch you up right now on the 2:30 close of NYMEX crude futures here in New York, settling in right under $45 a barrel. Of course, those OPEC plus talks don't appear to be going anywhere at the moment. So you're seeing oil trending a little bit down here on the day for once again another day, I should say. Copper prices higher once again for another day. A lot of optimism here about this economic rebound worldwide. Of course, we got that Caixin index out of China that showed an uptick in manufacturing activity. Anytime you see that, you're going to see a bump up in copper prices. Gold trying to claw its way back above $1,800 an ounce. And keep an eye on what's been going on here in platinum. Platinum futures in New York right now back to their August level, and spot prices at one point today, Taylor, actually exceeded that $1,000 an ounce level, something that hadn't been at since February.
And the stock that we've been following within the commodity world today, frankly, it's all about shares of Exxon. And take a look at this, because analysts are really honing in not only on the write-downs, but really what it means for the company to defend the dividend. This, of course, means a dividend yield, which we know is dividend divided by price. Given the drop in price, the dividend yield has now surged to almost 9%. So you focus, Caroline, on the write-down of the balance sheet, but how this company thinks about defending that dividend going forward.
This is where the CFA comes into play. We thank Taylor for all things dividend yield. Meanwhile, let's focus in on this Exxon story. Let's go across the board when it comes to OPEC, OPEC Plus, the discussions there. Rebecca Babin is with us, CIBC Private Wealth Management Senior Energy Trader. It's been too long, Rebecca. We love having you on. Talk to us about what you're thinking Exxon is painting the picture more broadly for the oil space.
Yeah, so I think what Exxon has done in terms of their commentary overnight was essentially somewhat direct investors' attention to what they're doing right, and that they're getting the message about capital discipline, writing down assets, and kind of taking in the reality that most other oil companies have already recognized. And Exxon really has lagged behind that. And I think this is giving investors a little bit of confidence, like, okay, they've finally gotten the message. Still think there's a big sticking point, as you mentioned, about this dividend protection and their ability to actually fund this dividend. They need crude to be significantly higher than where it is now. And we haven't quite seen that yet. So there's still some suspicion that they might not be able to keep the dividend in 2021. But I think investors are reacting to the fact that they're at least heading in the right direction now. Not a full pivot, but a step in the right direction.
Yeah, definitely a little bit of a catch up here for Exxon, and that seems to be why the shares are trending a little bit higher on the day. Talk to us about the other sort of element of this, and that is where oil prices are and where they could potentially go. We've been camped out in that $40 a barrel range more or less now for months, and it doesn't really look like we're going materially higher anytime soon. What do you make of it?
Yeah, crude has been in a really tight range here. Let's call it 40, 45 for several months. And I think the fact is we have great news that came regarding the vaccine. And unlike other risk assets, let's call it equities, where you have a bridge and you can see across to the other side and discount back, crude and commodities have to actually cross that bridge step by step. And so that means even though we look out 6 months and things look a lot better, we still have to get from here to there. And from here to there, we have a significant amount of demand concerns upcoming. And the fact that OPEC Plus didn't reach an agreement could flip the deficit we were hoping to see in January in supply and demand flip to a surplus. So that every stepping stone in crude is kind of, every step forward is met with a step back. And it's just not this look through to the brighter side that we kind of see with equities.
How bifurcated is the demand side? Do you expect to see a recovery in jet fuel more so than the gas that we put in our tank? How do you think about the different aspects of demand?
Yeah, that's a really great point, because obviously gasoline for your motor vehicles has held up much better than jet fuel, right? And in China, you're actually seeing gasoline demand back at pre-COVID levels. In the US, it's still significantly lower, but it's really come back much more strongly. Jet fuel remains extremely depressed. And I would expect when we get the vaccine, that area of the market recovers much more significantly than traditional gasoline, but it's gonna take all assets of demand to recover. We're not gonna just be able to rely on jet fuel to take us out of this. We're gonna need gasoline and motor vehicle transportation to increase as well. And I think when I look at how the market's pricing in that demand recovery, we are kind of looking at the best case scenario. And I think the market is set up a little bit to be disappointed if we don't see the US recovery follow that China lead and everything snap back really quickly. So I think there's a little bit of a reason to be watching very closely that mobility data and how people do respond as we get opening up in vaccines.
Rebecca, you're saying that there's this risk of it snapping back. Just talk to us about positioning, what you're seeing in the market right now.
From a positioning perspective, there's some interesting things going on. Coming into the vaccine data, positioning was pretty negative and bearish, and I think that's part of the reason why you saw this massive rally, not only in the commodities, but in equities, which to nobody's great surprise, energy equities remain a huge underweight for everyone in the universe. In the commodity right now, there has been some length coming back into Brent from traditional money managers. However, we are seeing this short building in other investment managers that aren't classified in the CFTC data. And it does tell you that there's still underneath this rally, there are people and investors, maybe high frequency traders, looking to sell into strength because they don't necessarily see this as being a long-term sustainable rally.
Rebecca Babin, great to have you. CIBC Wealth Management, thank you. Stay well. We look forward to seeing you again soon. Now, coming up, it's everyone's favorite stay-at-home stock, and it's heading for its biggest loss in 3 weeks. Why Wall Street is wary about the outlook for Zoom. It's our stock of the hour next. This is Bloomberg.
All right, time now for our deals report, and we're talking Vimeo. It's seen a spike in business during the pandemic as companies scramble to build out those digital channels. Vimeo, it's a software as a service video platform and has been under the umbrella of IAC, that's Barry Diller's company, for over a decade. IAC CEO Joey Levin recently suggested that Vimeo could be ready for the public markets. Now, Ed Hammond caught up with the CEO of Vimeo to discuss the IPO timeline and what that could look like. Take a listen.
We actually haven't decided whether we're going to spin off into a public company. We have announced that we're contemplating it, and that is exactly what IAC, Vimeo's parent company, is doing. For the platform, though, we just raised $150 million at a multi-billion-dollar valuation. We have plenty of capital, and given the demand we've seen from the pandemic, we're really just focused on how we can be more aggressive in investing for growth and in our product.
As you say, it's not determined exactly that when you will, indeed, if you will spin off, but Joey Levin, CEO of IAC, did say in a recent letter that he thought you would have much better access or much cheaper access to capital in the public markets versus being part of IAC. Why does a company like Vimeo need that capital now?
So I think the reason that we're excited about the capital, Vimeo was profitable in Q3, but the market opportunity for us is so huge. We are today a video software company for every business of any size to use video. Every business needs video. And so we just have this great opportunity with a wonderful product to get it in the hands of more people. And so for us, the capital is so that we can invest in R&D, innovation, expand internationally, and really just empower more businesses to create, collaborate, and communicate with video.
And look, that growth that you talk about has obviously been phenomenal during COVID. I think 30-40% revenue growth per month through the crisis. How do you harness some of that so this doesn't just become a sort of pandemic success story, but is actually something you can build on longer term?
Yeah, so in many ways we sought out to fulfill a demand well before the pandemic from businesses. And if you actually look at the ways that businesses are using the platform today, It's for the types of things that we would expect to endure. It's small businesses and entrepreneurs making Instagram videos to reach their customers, putting videos on their website, running conferences and town halls. We have yoga instructors and studios doing digital classes. All of those things should really continue post the pandemic. And I'll give you a great example, Ed. LA Dance Studio was pre-pandemic getting about 150 people to attend their performances. They started live streaming those performances to a global audience, and they got over 150,000 in one show. So we expect that once people feel and experience the power of video to reach their customers, they're never going to go back. They'll certainly go back to in-person, but it will be an and, not an or.
But let's talk about those customers, because look, at the moment, as you say, everyone is doing everything over video. We're doing this call over video. That is a necessity of the crisis that we are currently in. How do you improve the service or change the service so that those customers and their experience on video is better than it would be in person, so that remains even once we're back in a normal environment?
Yeah, and look, it all comes down to building incredibly simple solutions and tools that really make it easy for a business, regardless of their size, their expertise, or their budget. And so the types of things that we're doing, we're investing in mobile creation tools so that any business can make 5 to 10 social videos a week with just a couple clicks. We're building a variety of different video tools so that any large organization, any Fortune 500 company can use video, not just for an event or a town hall, but for HR training and onboarding, for marketing, for knowledge sharing. We really think that video should be a primary way that businesses communicate with their customers and employees, and we want to be the single corporate video solution for them. And so really, I think for us, it's really about taking that capital and building much more powerful solutions that are very easy and accessible.
And as you say, you've become the sort of primary provider for the corporate space. You obviously, a few years ago, went away from being a sort of consumer or retail product. Is that an area you would potentially look to go back into if you were to become public, and therefore there was, sort of more pressure or more opportunity perhaps to grow in new areas?
No, we don't have any plans to deviate. We see the opportunity to be the video software solution for every business as massive. We think it is the most exciting opportunity for us, and we think we're well positioned to win. So, for us, this is just about doubling and tripling down on the growth that we're seeing.
Anjali Sud, Vimeo CEO, speaking with our own Ed Hammond there. Time now for our stock of the hour, one video company to another, but this one's, is public, and it's Zoom Video. Revenue quadrupled once more in the third quarter, but sustainability concerns and cost controls are pulling the shares sharply lower, off by 15%. Let's get more of the inside track. Dave Wilson, take it away.
If you just looked at the fiscal third quarter numbers out of Zoom Video, you'd wonder what the problem was. I mean, they were well ahead of analyst average estimates in the Bloomberg survey, whether you looked at the top line or the bottom line. I mean, they've certainly been among the biggest beneficiaries of people working from home, students staying at home. The shares were up sevenfold before the results came out. And in fact, it was the second best performing stock in the Russell 1000 index. Only Moderna had a bigger gain, and it actually beat Tesla even. It looks like one of these cases that, as the saying goes, to whom much is given, much is expected. And, expectations just didn't get borne out by, what the company had to say about this quarter. I mean, they're looking at slower revenue growth. I mean, you're talking about 330% increase from a year ago. Maybe another way to look at it is to say that on a quarter-to-quarter basis, they're anticipating 4% and change max in terms of revenue growth. You go back to second quarter, they were doubling on that basis. So clearly things are slowing down. And even if you look at a year ago, you can see that, given what analysts are anticipating and given what's happened to their profitability, their gross margins have been coming down. In this past quarter, their cost of revenue was 32% higher than analyst average estimate. As far as the fourth quarter goes, they're talking about spending more, capital expenditures going up because they're building out data centers. They have to be able to deal with all the conferences that people are having, and that means higher costs. So, the company's even looking at earnings that are going to be down from the third quarter. 79 cents a share tops when they made 99 cents last quarter. Again, it's the direction. And what happens to this company going forward, once the pandemic actually starts to be resolved, once we see vaccines and so on.
Yeah, that's going to be the big question. Dave Wilson there, our stock of the hour. Zoom video down right now about 15%. Coming up, shares of PayPal up high today. Upgrade from Mizuho. We're going to talk about why the link to Bitcoin may be driving it. That's coming up next. This is Bloomberg. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. FedEx, first up, getting an upgrade today to overweight from equal weight over at Barclays. 360 is the target. The analyst citing an abundance of growth opportunities given the acceleration of e-commerce during the pandemic. Shares here up 1% on the day. Next up, TripAdvisor getting an initiation today with an outperform and a $35 target over at Bernstein. The analyst there says it's the only online travel stock, he says, worth owning. Shares of TripAdvisor up 6.6% on the day, and PayPal having a monster day today at a record high. The price target being raised to a street high view of $290 over at Mizuho. The analyst there says Bitcoin exuberance actually boosting user engagement and propelling growth. Shares of PayPal right now up 2% on the day. And Caroline, those are some of our top calls.
And let us stick with that PayPal call. Dan Dolev with us, Mizuho senior fintech analyst. Interesting call. How much further is there to run in terms of this Bitcoin exuberance for PayPal's bottom line?
Thanks for having me. Look, I think it's just the beginning. The survey that we did showed that really a fifth of PayPal users in the US, per the survey, have already started trading Bitcoin. I mean, that means that there's still 80% or so of users of PayPal who haven't done this. And by the way, they haven't even opened it up on Venmo, which is another 60 million users coming up in 2021. So this is, I think, just the early stages of what turns out to be this big run in engagement driven by PayPal, by Bitcoin and PayPal.
And give me a sense here, Dan, as to what the usage is. I mean, is this basically just people using the PayPal platform to buy or I guess invest into Bitcoin? Are they actually using the currency itself for transactions on the PayPal service?
That's a great question. So right now they're just using it to buy and sell it. But remember, the byproduct of this, Romaine, the byproduct of them using Bitcoin on PayPal is that they're actually using other services more often. So they're using Pay in 4, which is a new feature. They're using QR code. They're using the PayPal credit. Those people are actually more engaged than the other people. Down in 2021, coming up in a month or so, they're going to start being able to actually buy and sell things using Bitcoin on one of any of PayPal's 28 million global merchants. So this is coming. This catalyst hasn't even started yet. We're just talking about buying and selling off Bitcoin, which creates a byproduct of more engagement.
Dan, what is the risk, though, that when Bitcoin comes off the record highs, engagement, too, starts to fall?
Yeah, look, this is a great question. We've seen this before. We've seen this with Square. You know, I've been doing this long enough. So in 2018, I think, when Bitcoin started trading off after the highs, Square was perceived as sort of a peg on Bitcoin. And because it ran up because of Bitcoin, it came back down. Now look where it's today, you know, kind of $200. So I think that the end of the story is very clear on Square. I think there's a portion of it on PayPal, which is it becomes a Bitcoin sort of peg. But because there's just so much more in terms of engagement, in terms of the revenue opportunity from those users doing more with PayPal than they did before, I think people are going to overlook that sort of Bitcoin peg trade, and the engagement will stick regardless of how much Bitcoin people are trading. So it's a way for them to get more people in the door, engaging more frequently than they did in the past. And that's what the survey shows.
All right, Dan, this is a really interesting research here. And you've, of course, been banging the drum on PayPal and a lot of these payment companies for a while. And you've proven so far to be correct. Always great to get your thoughts here. Dan Dolev, doing some great research there over at Mizuho, senior fintech analyst. All right, let's get a check here on the broader markets right now. It is a relatively positive day here. The S&P 500 up more than 1%. The Russell 2000 also getting in on the action today. And Taylor, 93 basis points there on your 10-year yield.
Huge. Huge. And on the 30-year, we're up similar, right? 11 basis points to a 168. You just wonder when the Fed starts talking about yield curve control. Although it was interesting, Tracie McMillion, Caroline, saying that they think the 10-year could go to 1.5. 93 doesn't get them excited.
Huh. But really it feels that the 1% mark has always been a cap, whether or not you start to buy into it, whether the market starts to buy into it. We don't seem to be. And for once, we're getting excited we might break this trading range. The US dollar as well. Yeah. Continuing to plumb new depths, hey, Romaine? Yeah, and we should point out, like, 10-year break-evens right now are still at, like, 1.8%. So how's that for... your 2% target? Hitting the Fed target there. Hot, running hot. What's hot? Well, the VIX isn't.
This is Bloomberg.
We are counting you down to the close. Just 1 hour left in trading. I'm Caroline Hyde.
All the major indices right now up about 1% or so. I'm Romaine Bostick.
I'm Taylor Riggs, and it looks like stocks only go up today, and so do the individual sectors. If you go beneath the headline service, everything looks green on the screen, but it is a little bit more of the defensive tone to it. You have tech, of course, which has been the big defensives of 2020 up top. You do have financials because yields are up 10 basis points across the curve. But down below, that's really where that value trade comes into play. Romaine, energy, industrial, staples. That is the real risk on sector, but they're the laggards, at least for today, though still in the green.
Yeah, and take a look at some of the individual movers here. We got some preliminary results out of Micron, basically providing an outlook for that quarter that just ended on November 30th. Investors seem to like what they hear, up about 5%. We also got preliminary results out of United Health, and they gave a forecast for the next year going forward, 2021. Investors also like what they heard there. Nikola, down again here, fourth straight day, 15% here. They've now lost about 50% of their value just over in the past week. And QuantumScape Corp, a company we don't talk about a lot here. They make these lithium batteries for EV vehicles. They have been doing well, doing phenomenal. Of course, this was a company that had the backing of a fund that Bill Gates is a part of. A lot of big names attached to this. They had a partnership with Volkswagen. Not really clear. There's no real news out here, but keep in mind, this is a huge drop for the company right now. Remember, they just came to market just about a month and a half ago.
Ooh, all falling out of favor. Nikola's QuantumScapes. Meanwhile, though, I'm going to talk panic euphoria. It's not an index we look at enough, but Citigroup has it. And actually, this was a great quote that Taylor brought to our attention earlier this morning, coming from Tobias Levkovich. We know him well. We talked to him here on this show. And I love the turn of phrase he used. He said, our sense is that the idea of no alternatives on buying broad-based equities has led to an overshoot. Current euphoric readings signal a 100% probability of losing money in the coming 12 months if we study historical patterns. So clearly, he is currently saying the market has gone too far, too fast at the moment. We are at record highs in the S&P 500 and the NASDAQ. Really remain. The key question is whether we can hold these sorts of levels. Yeah,
it'll be an interesting debate here. Of course, we've heard this phrase before that the market has gone too far, too fast. And of course, look where we're at right now. Let's get a little bit more insight here and bring in Kathryn, Rooney, Vera. She's head of global market macro and chief investment strategist at Bulltick Capital Markets. I will get it right. Kathryn, always a treat to have you on, joining us today from Miami. Let's start with, I guess, your general outlook here for the market, because it's easy to look at the gains that we've made here over the past 11 months in defiance of the COVID crisis and all the other issues that went on with the economy. This is going to be a remarkable year for U.S. equities. Are you confident that there's still some more gas left in the tank here?
Well, I think that markets are closing in a phenomenally volatile year in a euphoric manner. So I liked the preface to my interview. I think that markets are in a full bull scenario. I think that the vaccine, which is undoubtedly fantastic news, I think is being inappropriately the equivalent to immediate eradication. I think that there's still numerous risks in the near-term horizon, not least of which comes from the January 5th runoff elections in Georgia, which could tip the scales in the Senate. I think the market is not paying enough attention to that. And I think thirdly is economic deceleration. I think that's something that we should really consider as a risk going into 2021, given that lockdowns are going on right now. And until we do get the production, distribution, and successful acceptance, and we know that the polls show that the majority of Americans would not voluntarily take the vaccine. Until we get there, I think that we run a real risk of economic dampening due to intermittent lockdowns.
Interesting you say that, Kathryn. Powell cautioning that to lawmakers today. We got a little bit of a sign of it from the manufacturing data in the US, which does show strength, but in the labor market part of that index showing some weakness. Where then to hedge? Where then, if we are at these lofty levels in the main benchmarks, should you be putting your money to work?
Well, we are at lofty levels, but we have two dominant factors, Caroline, that are going to continue to be the most important forces going to 2021 and beyond until effectively we get some semblance of inflation. And that, of course, is fiscal stimulus, which is, I think, inevitable, and monetary stimulus, which is the be-all, end-all, right? So I think given those two phenomenal forces, when we do get a market drop, it has to be a time to accumulate. I mean, that's been the story for the past 10 years, but the story has not yet changed. So what I'm recommending to our investors is a barbell strategy. Follow the Fed. Of course, we have to do that because we don't want to be out of this game. We don't want to be out of the market and miss big opportunity costs. So we want to be long risk, overweight equities, undoubtedly. But I think we have to rotate out of the U.S. and look for value in the emerging market space. Flows are starting to pick up tremendously there, Caroline, in highest last week since February of 2019. So investors are realizing that rates are going to stay inordinately low for a sustained period of time in the developed world, and we've already maximized value there. So they're starting to look for that yield in the emerging market space.
Does 93 basis points on the 10-year then start to get your attention?
Taylor, you said something before my segment that I completely agree with. When are we going to start talking about yield curve control? And that, I think, too, is inevitable. So once the 10-year, I think, breaks 1% to the upside, the Fed is going to engage in yield curve manipulation. It already is, but I think it's going to be more pointed because let's face it, a 10-year Treasury yield that is in an incessantly rising trend goes completely against everything that the Fed's been so arduously working towards in terms of keeping mortgage rates low, consumer lending rates low, and expanding and extending this economic expansion or recovery, rather. So I think that it doesn't scare me. In fact, that's the other end of the barbell. I think at 1% and above, you want to go long treasuries. I think you want to buy tips. I think you want to be long in gold. I think you want to buy puts even, just as some protection. And I don't mind having an elevated cash position going into 2021.
And I mean, and some of those trades have already paid off handsomely so far this year, Kathryn. For those folks maybe who want to stay, want to maybe look outside the U.S. a little bit more, how comfortable are you right now with the setup with some of those EM names?
Very comfortable, Romaine, and I'll tell you why. The best scenario for the emerging market space is a scenario of low developed market rates, right? So you have that carry trade, combined with a weak dollar. And we have a phenomenally weak dollar. And my expectation is that that's a structural trend over the years. So combine that with flows and underweight positioning in the emerging market space, that tells me that we are just at the beginning of capital flows and portfolio flows entering the emerging market space. So I think combined with economic growth on a global scale, a weak dollar, low interest rates, I think that's setting a very pretty stage for emerging markets, specifically China, and I'll even add to that Latin America, which is still battling, tragically, COVID very aggressively. But I think there's value there.
Still value there. We keep you all eyes on what Kathryn Rooney Vera has her eyes on, Head of Global Macro and Chief Investment Strategist at Bulltick Capital Markets. Thank you for coming on and talking about the euphoria in the markets. Now, coming up, well, we talk about the all-in-one shot that Tesla is rallying as the company will be added to the S&P 500 all at once. We'll discuss how money managers will have to adjust their portfolios for the $538 billion car maker. Plus, Airbnb aims high. Will the home rental platform hit that market value of $35 billion it wants as more IPOs file in? And Ready Player One? Why Universal Studios still plans to open its $580 million Nintendo park in February despite the pandemic. All that and so much more coming up. This is Bloomberg.
All right, welcome back to Bloomberg Markets to close. 47 minutes to go, counting you down to the end of trading today. Take a look at where we stand in markets right now. The S&P 500 right now at a record high. The Russell 2000 only about 5 points away from its record high. You got dollar weakness on this day. And look at this, a little bit of a sell-off going on in treasuries, all the way pushing yields all the way back up to 93 basis points. You flip up the board, you take a look at what the NASDAQ 100 is doing. Record high as well there on the top. You take a look at the MSCI Emerging Market Index, just a few points shy, about 50 points shy of that 2-year high. So you're talking about records all around. Bitcoin selling off a little bit today, but still camped out right around that record high. But take a look at that second line here, 2076. Right now on the VIX, we've been averaging above 20 on the VIX for the last 10 months. We're starting off the month of December above 20 as well. Where the VIX breaks down or up could be a big determinant here of how folks feel about this rally and its sustainability. Caroline.
Meanwhile, Romaine, this is one for your son. If you've ever wanted to ride in a real Super Mario Kart, you'll get your chance next year. Universal Studios Japan plan to open its long-delayed, about a $500 million Super Nintendo World on February the 4th. The park's launch will be a crucial test, though, of whether consumer demand for amusement parks will return amid the pandemic. Now, Bloomberg Quick Takes reporter Kurumi Mori has been to check it out.
We finally get to see Mario Kart in real life.
We're at Universal Studios Japan in Osaka, and the first ever Super Nintendo World will open here on February 4th, 2021.
We're inside Koopa's castle, also known as Bowser in English. This is the start of the Mario Kart ride. It's pretty cool in here. You can see all of these fittings inside. I'm seeing that it's a 4-player car. You each get a handle and an AR headset. It's also a competing game. So there's 2 tracks. This is one, there's one on the other side. So you'll be racing against other players. And they've been working on this ride for about 6 years now, so a long time coming. Everybody's been waiting for this. One thing though, it is on a rail, so it won't be exactly like the game. You won't be freely driving around the course. I do want to point out that Super Nintendo World did look a little small. I wonder how they'll handle the crowds with the pandemic. And what about all the interactive elements? Will they sanitize everything? Still a lot of question marks. The good news, though, is that Nintendo is already building a rumored Donkey Kong area next door, so still a lot to look forward to.
Thank you to our own Bloomberg Quick Takes, Kurumi Mori, for that report. Let's get a quick check on some of the latest business flash headlines and what is moving as we head towards the close. Shares of Kohl's jumping today. The department store chain says it will install Sephora shops inside hundreds of locations. Kohl's had previously said it would expand its beauty section. Kohl's will open the first 200 Sephora shops next fall. It is a double blow to British retailing that could leave thousands out of work. Department store Debenhams says it's preparing to close for good after failing to find a buyer. And the parent company of Topshop and Dorothy Perkins, as we were announcing yesterday, they've started insolvency proceedings together that could lead to a loss of almost 25,000 jobs. Amazon is trying to avoid Google's fate with European Union antitrust regulators. The company is now trying to address enforcer concerns before the legal process goes too far. Google ended up paying about $9 billion in fines to resolve its EU dispute. The bloc's competition chief, Margaret Vestager, says Amazon has been very forthcoming in trying to solve the issues at stake. And the new oversight board at Facebook has picked the first 6 cases it will review. The panel was created in response to criticism of the way the social network handles controversial content. 3 of the cases involve hate speech, the other, violence, misinformation about the coronavirus, and nudity. Caroline, I'd leave you with that.
Thanks. What a joyous segue to just spin us straight forward to Options Insight. Abigail Doolittle is here, and Abigail will be looking at the bull case versus the bear case for stocks, eh?
Hard not to, given the fact that we have stocks continuing November's big uptrend right into December. Nice highs here for stock indexes. Christian Fromhertz of Tribeca Trade Group, thank you for joining us to talk about, yes, both the bull case and the bear case. So to start out with the bullish case, you're talking about the old adage, the trend is your friend. And on the other hand, I guess the VIX is doing what it should be doing, really separating from the S&P 500. But at some point, the two converge. What are you seeing here on the bull side?
Yeah, sure. Hey, Abigail, great to be here. Yeah, I mean, I think, of course, this is, continues to be a very interesting market. But yeah, I mean, I tend to look at things, what I call, above the hood analysis, where I'm looking at price and trend. they continue to move higher, and we're continuing to see, under the hood, little rotations going on, a little bit of growth for a couple of days, a little bit of value for a couple of days. I like that. I think that's a bull market, and we're continuing to see market breadth continue to kind of break out. It's not a straight line up, but it continues to kind of come in a little bit and then break out a little bit. So I think right now, that's my case for the bull case, is that price and trend continue to move higher, and we're seeing good market participation underneath the hood.
And in terms of this divergence that we're seeing between the VIX and the S&P 500, you are supposed to see that clearly. As stocks go higher, the VIX will go lower, and yet that VIX is above 20. So is there any sort of a warning signal there as we segue to the bear case?
Yeah, so that's a great question. I mean, the VIX seems to be stubborn. It is not broken through 20. But, this has been a very unusual year. I mean, 2020 is probably, one of the most unusual years I've ever seen. So, I think as long as it's kind of moving in the right direction, we'll see if it does hit, if it does get below 20, probably in the next week or two.
Right.
If not, one of the things, moving to that bear case is, I want to look for divergences where I see something like the VIX going up while price is going up. That would give me a little bit of a warning sign, as well as a breadth breakdown.
Yeah, that would certainly be a little bit nerve-wracking. And here on the screen right now, we're showing a fear and greed index internal to Bloomberg, a study on the Russell 2000. And it's interesting because sentiment feels like it's to the upside, and it is certainly high, but it's coming off of the highs. Taking a look very quickly at your trade, Christian, I have about 30 seconds for you. Apple and the chips are climbing.
Yeah, I mean, we're seeing all kinds of option activity in the semiconductor space, probably about 6 or 7 different names over the last couple of days. What I like is a name that's actually said that they're coming out with their own chip for the iPhone. I like Apple here. January 125 calls, a little bit under $5 you can spend. And Apple, which has been quiet, the last couple of months, looks like it's trying to break higher out of consolidation.
Packing lots of information into a short period of time. As always, Christian Fromhertz, thank you for joining us for Options Insight. And from New York, this is Bloomberg.
We continue our theme, taking a look at emerging markets. And this time yesterday, we were talking about some of the overnight data that we got out of China. There was an update to that because we got further overnight data. This time, Caixin China PMI Manufacturing Index also confirming the positive data we got yesterday, 54.9, better than estimates, up from the previous month. For more, I want to bring in our Daybreak Asia anchor, Sherry on, because you too were also noticing the positive numbers coming out of South Korea within manufacturing as well and exports.
Yeah, those China numbers are really helping neighboring South Korea as well, especially given that Caixin PMI number also included new order exports of sub-index, which really shows a positive outlook. So this GTV chart on the Bloomberg showing third quarter GDP numbers out of South Korea really growing faster than originally expected, up 2.1%. Exports also rising. Manufacturing PMI hitting the highest since 2011. And the reason that South Korea is important, of course, is a bellwether for world trade. So it suggests that demand in the global economy is holding up. And switch up the boards and take a look at this other GTV chart on the Bloomberg showing PMIs across Asia. And this shows you that Japan also saw the best reading since August of 2019. Taiwan, highest since January 2018. We're seeing really, really strong recovery when it comes to these Northeast Asian economies, perhaps because they have such big shipments of electronics, semiconductors. Not so much for, say, India's manufacturing, which fell to a 3-month low. Perhaps Vietnam and the Philippines also in contraction, a little bit of divergence in Asia as well.
And so, Sherry, when we talk about sort of the economic recovery that we're seeing in Asia, is particularly in China, a lot of that was tied to the general assumption that the COVID crisis was sort of under control. But we're now starting to see cases rise in certain areas, and Hong Kong now imposing new measures to restrict people's behavior.
Yeah, you can't go partying on boats anymore, which, of course, if you've been to Hong Kong, is a big deal. That's what you do if you're Hong Kong. Now, the government is establishing this hotline for residents to report these parties aboard rented party boats. Of course, nightclubs, karaoke bars, schools are closing down. That key travel bubble with Singapore has been delayed again. That would have allowed travel between Singapore and Hong Kong without a quarantine. Philippines now talking about perhaps subsidizing coronavirus tests for tourists. We know that tourism is so important, even for countries like Japan, where they've tried to really boost domestic travel, and the national government has offered big discounts on travel inside Japan. But even this new wave of cases in Japan really not helping.
Oh, the heady mix of a junk boat and a jelly shot. Those were the days that are no more clearly in Hong Kong at the moment, sadly. They will once again. Sherry, you're someone who not only keeps a keen eye on Hong Kong and Asia, but also what's happening in Latin America, and big news out of Brazil in terms of the fiscal support there.
Yeah, because these economies have really relied heavily on those cash handouts. And the Brazilian president, Jair Bolsonaro, saying that those handouts cannot go on indefinitely. This actually providing some relief to the markets. And you saw Brazilian real today really leading the gains in EMFX. Of course, Brazil's public debt now nearing 100% of GDP. Chile's economic activity also unexpectedly contracting in October. And it's the same story, the service sector seeing weakness, and those early pension withdrawals, which have been very controversial in Chile, really not even helping in that front.
Sherry-Ann taking us around the world. As always, we thank you, host of Bloomberg Daybreak Australia and Daybreak Asia. Meanwhile, we bring you back to the markets right here, right now. And we are record highs on the Nasdaq, record high on the S&P 500, record high on your global all-country world index. The pound also gets a boost. Brexit still goes on. This is Bloomberg. We have about half an hour left of the trading day. This is Countdown to the Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs, and we get right to it as we come in on that closing bell. It is green on the screen across the board and across all the sectors, but Romaine, I'm really highlighting the defensiveness that is underpinning this rally. Tech, of course, as we know, the defensive sector of 2020 is the outperformer, where on the bottom, that value, that cyclical, that risk on trade like energy, industrials, they're in the green, but much less so.
Yeah, let's take a look at some of the individual movers out here today, Taylor. Of course, all eyes are going to be on Salesforce after the bell. That company, of course, reporting earnings. A lot of concerns about its revenue growth. Remember, for the last decade, it's basically reported 20% plus revenue growth every quarter going forward. It's expected to be about 16% for the third quarter. Of course, most people aren't going to be paying attention to that. What they really want to know are the rumors. Is Salesforce going to buy Slack? Of course, Slack shares are up about 48% over the past week since those rumors started to circulate in the media. If there is some sort of formal discussion between the two companies, that would be a material event that presumably Salesforce would have to disclose. Keep your eye on that space. Array Technologies, a solar company, taking a leg down. Remember, they went public back in October. One of their main shareholders, Oaktree, selling off about 25 million shares. And I don't really point to microcap companies much. Arlo Technologies, a company that typically trades about 1 million shares per day, Caroline, today trading 26 million. They make those little wireless cameras that you can get over at like Best Buy or something to put in your house, you know, for security, to surveil your kids, your dog, whatever.
Would I do that?
I don't know. But guess what? Apple is selling them now.
Huh.
So I guess that's good enough for a 32% pop there. I don't get it.
You go micro, I go macro. I love it. All things are low, but now I'm taking all things, well, once again, the tried, the tested, the true measure of how many companies are currently trading above their 200-day moving average. 93%. I love some of the turns of phrases, the superlatives that are coming out. Peter Butfer over at Bleakley Advisory Group saying the bull boat right now is standing room only. Check this out. At the moment, the 200-day moving average now up at 90%. This just shows you the breadth of the rally that we've seen, but also a technical indicator. If you're above 80%, that usually means it's time to pull back. Not yet, so says the market, Taylor.
Well, if we want to talk about a rally, there is no other stock than to talk about other than shares of Tesla rallying, of course, as investors really cheer the S&P 500 debut. And money managers are getting ready to adjust their portfolios for that $500 million company. For more, let's bring in Bloomberg's Isha Day. Isha, how are they going to do this all in one sitting for a $500 million company?
Hello, and thanks for having me. That's a great question. So, if you remember when S&P last month said that Tesla is going to be added to the index, it also said that, it was trying to consult the financial community on what would be the best way to add the stock to the index and if it should be added in the usual way in one go, or if the listing should be done in tranches, break it up. But after considering the feedback it received, S&P yesterday said that it has decided to do it the traditional way, and just all of this $500 billion company will become a part of the index on December 21st. So, you know, it's kind of business as usual, except not really because it's such a huge company.
Business as usual, but such a huge company. Are we feeling that we're at a really rich level now, Aisha, or is there still room to run once it becomes a member of the S&P 500?
Right. I mean, the valuation is rich. The valuation, as a lot of experts have pointed out to us, is you know, it doesn't really have room for much correction or much risk. That said, we are expecting the stock to kind of keep rising into that December 21st date. So let's not be surprised with further rallies here. However, after that December 21st date, once it actually becomes a member of this prestigious index, we can kind of expect to see some sort of a retreat in the shares. Some people have told us that the retreat could be as much as 20%, but you know, but that is something that kind of pales in front of the fact that the stock has risen 600% this year.
All right, so this is going to be a big liquidity event, either up or down, depending on how this shakes out. Somebody's getting bumped out at the S&P, Aisha. Who?
Yes, that's a good question. Everybody wants to know who, but we do not know yet. S&P has told us that it will be announced. The name of that company will be announced on December 11th. So let's watch that space. However, you know, it will not be a company as big as Tesla, right? It will be a much smaller name. So that is not an event that money managers are probably going to be eyeing very closely, broadly speaking. But yes, it would. Somebody will have to come out.
You talk about the date, just going back to the addition and the subtraction of these companies, December 21st. We're thinking it's right before Christmas. We're expecting perhaps low volume. How does this actually get done? How do the money managers, how much time do they have to start making adjustments to their portfolios if they do indeed track the S&P 500?
Right. So money managers that are, you know, handling funds that are indexed to the S&P 500 will now they have like almost 3 weeks to start making the adjustments. Adjustments, obviously, if you're indexed, you're mimicking the index, you will definitely be reallocating your portfolio. So we will definitely be seeing a bit of a volatility in the market. But let's remember, this is 2020. This is a year of disruption. It's a really highly volatile year in general for the U.S. market. You know, some people are telling us Tesla shares, there could be demand from fund managers for at least 100 to 120 million of Tesla shares. And that seems like a lot of shares, right? But at the same time, it's kind of dwarfed next to some 10 billion US shares that change hands every day. So yes, a big event for the markets, but is it hugely disruptive? No.
Aisha Day, across all things Tesla. We'll see how that continues to unfold ahead of December the 21st. Elon Musk currently bracing his own employees for the fallout in his share price. From New York, this is Bloomberg.
In one of the busiest years ever for U.S. listings, Airbnb looking to go big in its long-awaited IPO, seeking a $2.6 billion and making it now the fourth biggest in the U.S. this year. Joining us now with more, Bloomberg's Crystal C, who covers IPOs for us. Crystal, I'm just curious about their business model. We're in the middle of a pandemic, and yet there seems to be so much investor demand for them. The long-term fundamentals, are investors confident that can play out even in a post-COVID world?
Yeah, that is what Airbnb's pitch is, that, you know, once everything goes back to normal, they will have, you know, you can look back at the fundamentals and they have been around for years, and they have years of track record to prove that it is a sound company. It has potential to be a public independent company, and that's always what they're doing here. They're seeking a $35 billion valuation, which is higher than the highest valuation as a private company. That was $31 billion in 2017. So it is a lot of just the range itself shows that investors seem to actually like this deal and think past COVID.
Yeah, I mean, this was a deal that almost seemed dead several months ago, and now to come in at a $35 billion valuation potentially says a lot about this market. I am curious, Crystal, if you could kind of expand on some of the activity that we've been seeing in the IPO space and just the investor appetite right now to get their hands on some of these companies.
Yeah, December we expect is going to be the busiest December since forever. Like, this is going to be the biggest month for tech IPOs for year end. Apart from Airbnb, we saw DoorDash actually launched their IPO yesterday. Both of them are expected to price next week and trade next week. Also on our horizons, we are also tracking Affirm, Roblox, Switch. They're all kind of consumer-facing technology companies, unlike the September wave, which is mostly enterprise software. So this is showing the kind of optimism in the market and within the investor community that, you know, maybe this is the time we play that reopen trade and not so much the stay-at-home trend.
There was an interesting story that caught my eye, Kristen, and of course, Airbnb is coming to the NASDAQ, and the NASDAQ was interestingly saying that they're going to put out new board-level diversity disclosure requirements for companies going public. Is that something that you were thinking would come this way? How is that being taken down?
It is actually pretty unusual for the exchange to demand the regulators to put in extra regulation, because usually it's the other way around. But this is really one step towards the right direction. What NASDAQ is doing is taking what the California rule one step further. California, an incorporated company have to have at least one diverse board member when they go public. And actually, even when they're a private company at a certain time, they will have to comply with that rule. But what NASDAQ is doing is to ensure that public companies on
technical issues.
And yeah.
We want to thank Crystal for bringing us the update on all things that. Quite amazing. Adena Friedman, of course, President and CEO of NASDAQ, saying, "We believe this listing rule is one step in a broader journey to achieve inclusive representation across corporate America." Hear, hear. Now, let's have a quick look at the rest of the markets for us. We've just been talking with Crystal about, well, the private to public markets. The public markets currently at a record high on that all-important NASDAQ benchmark. Global stocks, though, also at a record high, Taylor. And the pound, I just have to give a little bit of Brexit lip service, hey?
Well, thank God. We were missing it all day long. So we're happy that you got it in there. My eye, of course, continues to be on crude lower and yields significantly lifting up higher. We're up 10 basis points along the day on the 10 and the 30-year. This is Bloomberg.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
Let's check in on those record-breaking majors, because once again we hit the heady highs and we go push higher as we see the S&P 500 currently up 1.1%. Volume's very slightly lower on the day, but overall we're not quite at the all-important 30,000 sacred number for the Dow, but the NASDAQ is leading the pace at 1.2%, another record high. Romaine, it really does feel like plenty of risk on, but there's plenty of reason to be cautious still.
Yeah, reason to be cautious, but still a broad-based rally today. You talk about the transports rallying. You're seeing a lot of those airline names get bids, Southwest, JetBlue, as well as some of the, I guess, travel stocks like an Avis Budget, up 4% here on the day. The KBW Bank Index also up higher. Of course, you're seeing that move up in rates. That always tends to sort of underpin some of those moves there. The steel index, this was an interesting note out this morning over at KeyBank, raising a lot of estimates on steel makers, primarily because of some more favorable pricing conditions. So you have Cleveland-Cliffs, of course, the big iron ore maker, up about 8%, Timken Steel up about 6%. And then, of course, right there, you see at the very bottom, I don't know what that is. So I'm going to pause there. It's stumped.
Great analysis, level 4.
Great analysis,
right
level 4. This is why I failed CFA twice. But you know what, Taylor?
No.
Take it away here. I know you got your BlackBerry out. Keeping a tab on what's happening here in the markets.
Let's get right to it with more market analysis. We do that with Jason Katz, Managing Director and Private Wealth Advisor of UBS. Jason, always great to have you. Walk us through how you think about these markets at these moments with these lofty valuations, and yet they further climb ahead.
So this was a November to remember. All the stars aligned, right? We had likely divided government. We're likely to have a smooth presidential transition. We had a great earnings season. The Fed's accommodative. The incoming Treasury Secretary, Yellen, couldn't be more dovish and pro-stimulus. And the vaccine news has been unparalleled. And add to that, we may get a skinny deal. So you think about that in the context of the push-pull between this great vaccine news and these stars aligning, and yet you have this COVID surge. So the concern that I really hear from a lot of business people and investors is, will the COVID surge lead to mobility restrictions, which in turn lead to lockdowns, which in turn leads to an economic slowdown? So we need to get this stimulus to bridge the gap, even if it's a skinny deal.
So the market is currently pricing in that fiscal stimulus from your perspective, Jason?
Without equivocation, it's pricing in stimulus. It's probably pricing in imminent stimulus. And if it's not going to happen during this lame duck session and is pushed out until the Biden administration takes hold, we could be setting up for a little bit of disappointment.
So, I mean, right now, Jason, I mean, there's a lot of euphoria in the market, and in some cases it is justified. There does seem to be a discounting, I guess, of what type of agenda we may get out of Washington. The idea that there's going to be this gridlock, so we don't need to worry about any sort of major rollback back in corporate taxes or some of the other sort of business-friendly measures that we had gotten used to over the last 4 years. Do you buy into that general outlook?
I do buy into that, but it's 2020 and anything could happen. And I'm a little bit surprised that there's such complacency around these Georgia elections. So look, our base case is that the Democrats do not sweep. And frankly, even if they did, Vice President making such pivotal decisions when the economy is so fragile is unlikely as well. I'm not so sure they want to raise taxes or address energy in the context of an economy that's going to be hopefully recovering.
All right, we're speaking here with Jason Katz, Managing Director and Private Wealth Advisor over at UBS. He's sticking with us as we count you down to the close here. Taylor, it's a big day. I mean, Jason kind of summed it up here. I mean, anything could happen in 2020. BlackBerry could rally 50%.
And it is, believe it or not, and it had nothing to do with me. That's the good news. I did want to come back and take a look at where we are in terms of valuations, because at least on a price to earnings basis, we heard from Matt Maley yesterday saying that if we get to 3,800 on the S&P, you could be at 22.5 times forward estimates. On a price to sales basis, I stole this chart from our own Dave Wilson. He's speaking to Doug Cass over at Seabreeze. You're still looking at valuations that surpass $19.99. So as these stocks run further ahead, valuation something I'm keenly keeping my eye on. I want to flip up the board, and you guys, it is my stock of the hour. It is all about Salesforce. We will hear from them just after the closing bell. Not only any confirmation about the rumored deal for Slack, but $5.25 billion in third quarter revenue. Look for forward guidance of about $20.8 billion. RBI analysts are saying that really look at strong demand for customer service and commerce products. These are as enterprises are really investing in those areas at the expense of back office software. So Salesforce, of course, something that we're looking at. Finally, let's flip up the board. And Jason, I'd love to bring you back into this conversation, because today really the rally has been in the copper to gold ratio, copper on a tear, and so is that 10-year yield. You're up 9 basis points on the day. How are you folding in calls on gold with the $2,000 price target, with calls on yield if we think we're lower for longer, but then you get moves like today?
Yeah, so look, with the dollar weak and interest rates remaining low, gold looks like it will maintain this level and probably trade as high as 2,000 plus. We're not out of the woods with respect to uncertainty, and you need a safe haven trade, and it's not competing for bond money with interest rates this low. So I think it's an important ballast in a portfolio, and one that I'd remain long, and any further weakness, get longer.
Any further weakness, get longer. Interesting. So pile on in. You were just talking about how the business people that you talk to, the investors that you talk to are trying to dissect this market, trying to understand whether or not we get a second wave, third wave, and how strong that might be. Jason, what is the number one question that perhaps we're not swallowing enough that you're getting from clients?
I'd say the overarching question is, what do I do as an investor when traditionally a 60-40 blend was the way to navigate volatility? Because in the fixed income world, you could argue there's arguably as much, if not more, risk from an interest rate perspective. So trying to find that balance is really challenging. So clearly people are disproportionately overweight risk assets, but it's important not to continue to go with the school of what's worked. I'm not saying to abandon big tech, but you think about the FANG stocks and Microsoft, they're up nearly 47% this year. And you think about the rest of the market, those stocks are only up 4%. So we're looking to overweight equities, but in areas that there's a big valuation chasm, and that's in mid-cap. That's in emerging market mid-cap and small cap. That's in financials. That's in industrials.
What about, I mean, just hypothetical here, Jason. I mean, what if somebody comes to you, they say, basically they got out of equities or reduced their equity exposure significantly over the previous few months. They're looking to sort of re-enter. I mean, what do you tell them at this moment where you've had this massive rally and maybe there's still a little bit of risk out there and maybe jumping back in the pool at this moment?
What I'd say is you want to spend time in the market and not time it. That being said, given the magnitude of the run-up of 65% off the low, you have to proceed with caution. So dollar cost averaging and using any volatility to lean into cyclicality and select value is the way that I'd populate portfolios. I would do it slowly.
And Jason, I'm thinking about the moves that we've seen in the 10-year yield today. Does this start to make you wonder if the Fed discusses yield curve control, or am I getting ahead of myself?
No, I think that you're on point there. The Fed has very few arrows left in their quiver, right? It's really now up to fiscal spending and Yellen and company. And I think what you'll see from the Fed is if we do in fact pierce 1% on the 10-year, they'll come in and start to buy more assets on the long end. But certainly a 93 basis point 10-year as an investor is not piquing my interest. Real rates of return after taxes, after fees, you're looking at not making money. You're looking at losing money. So you have to be very careful in deploying money now in the fixed income world.
So what would start to make you bite? What level would you want to see?
Well, I think that you could be a buyer at or around these levels in the pro-cyclical areas. You want to look at areas that have disproportionately outperformed. You think about the growth index is outperformed by 33% this year. So value, EM, small cap and mid cap, especially with the dollar's weakness and rates so low there.
All right, we're speaking here with Jason Katz, Managing Director and Private Wealth Advisor at UBS, helping us count down to the close. He's sticking with us. 21 seconds to go here on a day which is shaping up, looks like it's going to be a record day here for the S&P 500. You take a look at the board right now, closing right now around that 366.3 level. Of course, it'll take a couple minutes for those numbers to settle. The NASDAQ composite also appears to be closing at a record high on this day. The Dow Jones coming up a little bit short. The Russell 2000, though, also participating here. So this was a pretty broad-based rally, guys, where we saw not only the large cap, the big tech names, but a lot of the small mid-cap names and, of course, a lot of those cyclical names get in on the action. Yeah, and we're going to take it across asset right now because I bring you to the GMM, the Global Market Matrix Factor, because I mean, not every day we talk about the Icelandic foreign exchange, but overall we are seeing a story of dollar weakness on the back of buying in stocks. And yes, a slightly defensive stance on that with tech winning. But once again, the story has to be dollar weakness, down at about 2.5-year lows. The euro, the key outperformer when you look at the G10 currency pairs, up 1.2% on the day. Maybe there's talk of further stimulus over there. The Swiss franc, usually a haven, also up about a percentage point against the US dollar. So interesting tactical moves. Really, it was only the Japanese yen that was weaker against the US dollar today. Looking at commodities, where we got a lot of action as well. I'm going to leave the bond story to Taylor, bright in red there today. But the WTI crude down by 1.7%. OPEC plus, we still get no real navigation on whether or not we get those production cuts. So clearly, we're seeing Brent off by a percentage point. It really was a story of oil as well as the money moving into the stock market today. Taylor.
And let's get right to those yields, because that's where we saw so much of the action today. You're up 8 basis points alone on the 10-year to a 92 basis points, and up 9 basis points on the 30-year to a 166. Jason, we were talking to you earlier about yields and how you think about moving down the credit scale. I've heard more and more people say we don't want the 10-year, we want to move down in yield in credit to pick up that yield. But at 400 basis points over treasuries, are you being appropriately compensated for risk?
Yield spreads have really compressed here. So if we're going to be in fixed income, You look at areas like high yield, emerging market debt, as I said earlier, that's dollar denominated. And there are other yield proxies that you could look at, whether it be business development companies or in the private world, REITs or structured solutions that could give you some yield. You're by definition going to have to take on a little bit of equity-like risk in your fixed income. So it's counterintuitive, but we're looking at income-oriented equities and fixed income that's more equity-oriented.
So staying on the yield discussion here, I mean, what does this sort of mean for financials? I mean, financials have had a hard time, at least as a group, catching up with the rest of the market. And I'm wondering if this time it is going to be different.
It feels that way to me. Banks are arguably overcapitalized, and loan loss provisions have really started to narrow. With the likelihood of a steepening yield curve, I think you're going to see net interest margins improve, and all this angst about overregulation of the banks. Frankly, I think Biden and company are going to focus more on consumer-related finance than they are going to target the banks. And if you want to short the bond market, the best proxy to do that, in my view, is to go long the major money center banks.
Interesting take. I also want to get your take, lastly, Jason, on volatility right now, because not all is sanguine at the moment. We are seeing really lofty levels on the benchmarks, but as Taylor keeps saying throughout the day, this has been a defensive play. We've seen technology in front and center today, and the VIX is currently up a little bit. What does it mean to have the VIX at an above 20 handle right now?
I mean, above a 20 handle relative to where we were just pre-election, it's still pretty muted volatility out there. And I think that's a sign of a degree of complacency. And I do expect, as we get into the dark, long, cold winter with COVID cases rising and a lot of hand-wringing around whether we get stimulus and how much, you're going to see VIX start to get a bit more elevated here.
Jason Katz, Managing Director and Private Wealth Advisor at UBS. We love having you. Great to have you back on camera. We thank you very much. Come back soon. Now, more markets coverage coming up right next on the Bloomberg Markets at Close. We will be looking at Salesforce. Of course we will. It's earnings. But really what you want to know is it buying Slack? This is Bloomberg.
All right, software company Salesforce is in an agreement to buy Slack. $27.7 billion is the enterprise value being attached to this deal. Of course, Slack closed today with a market cap of roughly about $25 billion. So that's going to be reconciled, probably slightly to the downside here. Of course, Salesforce also reporting earnings. But the big news here, Caroline and Taylor, is that this agreement that I guess we've speculated about for the past week has now apparently come to fruition.
And I think what's important, Taylor's been pointing out, that this isn't just a stock deal. Many had thought, well, it's a good time for Salesforce to use its lofty high prices of its shares and just pay in shares, but it's going to be cash and shares, hey, Taylor?
Like you said, $26.79 in cash, 0.0776 shares of Salesforce for each Slack share. So that does give it the enterprise value of $27.7 billion. Mark Benioff, as we know, the CEO of Salesforce, calling this a match made in heaven. Let's talk to the man who was helping us break down this when rumors were coming out about this match last week. Anurag Rana, Senior Software and IT Services Analyst for Bloomberg Intelligence. Anurag, talk to us about using cash instead of equity.
I think, as I told you before, I would have loved it if they used only equity. But, so what? They have a lot of cash. They generate a lot of cash. So, I don't think it's going to be an issue. And debt markets are open for them to borrow money. So, I mean, if that's what Slack, board wanted, I think that's what they got.
Yeah, I mean, they certainly had the option to do it either way and do it in a way that I guess could make investors comfortable. Anurag, I am curious, though, as to how Slack gets integrated into Salesforce, whether the sort of the mission here by Benioff is to sort of keep Slack more as an independent product that can sort of still flourish on its own, or is there some sort of broader, I guess, game plan here to merge effectively the Salesforce software into Slack?
I think for the time being, it will be an independent entity. And, but over time, we think it's going to be good integration with their core, software products, whether it's, sales, customer service, marketing, all those products would go well with Slack. I think if the way you want to think about it is chat collaboration app is the next big area of productivity for all of us. Just like over time, we have all had Excel and Word and PowerPoint on our desktops. Down the road, chat collaboration will be, one of the apps that we use. And, Slack is the first mover in this market. Microsoft's done very well. We think the market's big enough for both of them, as we have said in the past. But, what happens in this particular case with Salesforce strength, I think Slack's going to get a lot more momentum to tap into the enterprise as they were not able to do just as an independent entity.
Says in the press release, upon the close of the transaction, Slack will become an operating unit of Salesforce and will continue to be led by CEO Stuart Butterfield. And overall, of course, they say it will be deeply integrated into every Salesforce cloud. I mean, we only care about this deal, but we also have been getting numbers out of Salesforce as well. And how has it been continuing to thrive at the moment in terms of its growth trajectory? We're seeing it sees full-year adjusted earnings per share of $4.62 to $4.63. That is a significant upgrade, but of course that's sort of factoring in this deal, which they see closing by full-year 2022.
Yeah, I mean, the numbers are just flowing out, and I'm looking at as well. I mean, they look fine. I don't see anything that's, comes as a negative. Frankly speaking, if you look at it from just digital transformations in general, Salesforce is right in the middle of one of the most favorable, trends in technology right now. And, both Salesforce and Microsoft have really good tailwinds behind them for the next few years. So for Salesforce, if they can add more products to their portfolio, I think it works well when they are about to go to the CIO and sell one product, they can sell multiple products.
Anurag, talk to me more about the way in which they are purchasing this. Cash for Salesforce has ballooned from $2 billion to $9 billion, but debt as well has increased in 2017 from $2 billion to $6.2 billion, while cash from operations and free cash flow has remained steady. How quickly and how much do they need to tap the debt markets?
So, a lot would depend on the rates, but if you look at it, Salesforce can generate about $4.5 billion of free cash flow everywhere. I'm looking at consensus right now on the terminal. And, if you take that into account, for them to go out and borrowing a little bit of money is or even a lot of money shouldn't be a problem.
All right, and we should just point out, so a lot of headlines crossing the wire here on this company. We should point out Mark Hawkins, who's been the CFO there now for several years, going back to at least, I believe, 2017 at least, is going to be retiring here. We did read off some of those numbers here, Anurag, with regards to their sales growth coming in at about 20%. There was some expectations that we would start to see a little bit more of a slowdown in growth. I think the consensus on the street was for roughly about 16% revenue growth. The longer-term story here for Salesforce and really for Benioff is that this is a company that investors want to see grow, at least at this valuation, need to see revenue growth in that double-digit range. Are you confident right now in the trajectory that that is going to be the case?
I think organically they should be able to grow in double digits without a problem, just because the software as a service market or the cloud application market is still undertapped compared to overall tech spending. We have a long way to go before we hit saturation, frankly. And for Salesforce, given the strong portfolio of cloud assets it has, in one quarter you could see one product doing better than the other. But, as a whole, this is one company we think could be in the long run. I mean, we think it's fair to say that they are probably the only credible competitor to Microsoft right now in the market, with all the legacy companies such as Oracle and SAP struggling.
Watch Microsoft after hours as well, therefore. Anurag Rana, we thank you for bringing us all the inside track on this latest breaking news about the deal and, of course, the earnings coming from Salesforce. Here's from Bloomberg Intelligence. Meanwhile, former Federal Reserve Chair Janet Yellen was selected to be nominated to be the Treasury Secretary, and banks seem supportive of the decision. During an interview for Bloomberg Invest Talks with David Rubenstein, Citigroup CEO Michael Corbett praised the former Fed chair and also discussed the benefits of further stimulus. Have a listen.
I would say that not just Citi, but I think the banking industry had a good relationship with her. And, if she is elected into or if she is voted into the seat, I think she'll do a great job. And I would expect that relationship to continue. And I'd also, shout out another glass ceiling broken in terms of her then becoming the first female Secretary of Treasury, which would be another great one for the books.
Let's talk about the economy for a moment. There are many people in Washington and around the country who think the economy could use another stimulus bill. We couldn't get one so far before the election, but maybe in the lame duck there might be one, and maybe in the early new Congress. Do you have a view that the economy needs a stimulus bill to be able to go forward until we get all the vaccines distributed and widely used?
Yeah, I think, as you point out, David, it's unclear whether we're going to get that new stimulus package between now or late January. But I think if we don't get something done right now, I think we will get something done in probably fairly early 2021. And I think the question is not going to be the if, but I think it's going to be more about the size and what can get passed. And I think that will, be largely determined by the outcome of the Senate races in Georgia. I think right now, with COVID-19 cases on the rise, additional stimulus through unemployment checks, PPP loans, rebates are all helpful tools to bolster the economy, and while also helping individuals to recover from the economic hardship of the pandemic experience. And what we know, right, is that, while we're all in the same storm, we're not all in the same boat. And I think if we can get these monies targeted at those most affected, I think it would be a very good thing in terms of helping restore the economy otherwise quicker than it would.
Let's talk about the meaning of let's say we have a stimulus bill. Some people have said, well, we could use a stimulus bill. On the other hand, we can't ignore the fact that the debt is rising quite rapidly. We have about $27 trillion of federal debt, and we're having a budget deficit now about $3.2 or $3.3 trillion a year. We're borrowing about half the money that we spend each year. How much longer can we keep borrowing this money without people on Wall Street or people in the general economy saying this is too much borrowing? Are you worried about that?
I am. I think we all should be worried about it. I think we've been talking about deficits for a number of years and what is sustainable. I think the consequence and the prospect of lower for longer in terms of interest rates obviously significantly reduces or holds down that borrowing cost, but we can't believe that rates are going to stay necessarily where they are forever. So we've got to be mindful. And that's why I believe that it's actually very important that we're targeted in terms of getting the monies to those that are really in need, because we know that the longer this goes on and the more small business, the more individuals, certain geographies, neighborhoods get affected, it just makes the comeback from that much more difficult. And I think we've seen that, and that's been proven, from a historic perspective.
That was Michael Corbat, of course, who we know from Citigroup, the CEO, speaking earlier with David Rubenstein. You can catch that full interview on Bloomberg Invest Talks. It's this Friday at 10 a.m. Eastern. Caroline, we go back to the story of the day, which is Salesforce, and the numbers are crossing, and we get full year guidance that looks better than expected and blah, blah, blah. But really no one cares, because all we care about is, yes, they are buying Slack, as we know, cash and debt. They have a $10 billion loan that they are getting a facility to help fund that at a valuation of $27.7 billion. I
mean, the meteoric rise of Slack on the back of that news in the last few trading days. We are currently down by 3% as we understand that Salesforce will be using its cash as well as its shares to be buying Slack. But they say it is, well, a perfect union overall. Also notable that the CFO, Mark Hawkins, will be retiring as well from Salesforce.
In the meantime, let's get over to the First Word News with Mark Crumpton. Mark.
Taylor, thank you so much. One of President Trump's staunchest allies says he hasn't seen any evidence of widespread voter fraud. Attorney General William Barr tells the Associated Press the Justice Department has not uncovered proof of any fraud that would change the outcome of the presidential election. His comments come despite President Trump's repeated claims that the election was stolen and his refusal to concede his loss to Joe Biden. President-elect Biden set up his economic policymaking tone with a focus on reducing income inequalities as he introduced his economic team today. The team was led by his pick for Treasury Secretary Janet Yellen and several others who will help craft the incoming administration's response to the economic fallout from the coronavirus pandemic. Also on hand was Neera Tanden, Mr. Biden's pick to run the Office of Management and Budget. Trade talks between the UK and the European Union are, quote, so tricky and so difficult, but there could be a positive outcome in the next few days. That's according to European Commission President Ursula von der Leyen as talks continue in London. The British government told businesses today to be ready for big changes when the UK makes its final break from the EU in 1 month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Ariel Investments was the first minority-owned asset management firm, and it's grown to more than $12 billion in assets. Now, the company is looking to give back. This Giving Tuesday, it is speaking to all of its investors and donors to consider investing.
Romaine, I'm just going to take over from here. There's a slight mic issue, but we're talking about Ariel Investments. And, well, of course, we know that it's a company that's grown to more than $12 billion in assets. It was the first minority-owned asset management company. Now the company is looking to give back. It's Giving Tuesday, of course. Shonali Basak has an all-important investor, of course, John Rogers himself.
Yes, I do have John Rogers with me. Thank you, Caroline. And John, thank you for joining us today, a day where there's a little bit of hope in the air with stimulus talks coming back. But what we're talking about here is philanthropic giving, and it's a type of giving you're talking to all your investors about. So where can people give to have the most impact?
Well, I think the best way to give is to give in communities that you know well, around the issues that you know well. You know, Arnie Duncan and I grew up in the Hyde Park community of Chicago, and he coordinated all of our corporate giving when he worked at Ariel in the beginning of his business career before he went off to being Secretary of Education. And so our Ariel Community Academy is just a few blocks away from where Arnie and I grew up. And we're servicing the same kids that we've cared about and believed in for a generation now.
John, one interesting thing that I think a lot of people don't know about Ariel is that about more than 30 years ago, you started the Ariel Education Initiative. And every year now, you give more than $20,000 to a first grade class. What does that do? How does that help them? What kind of difference has that made so far?
Well, one of the things that's it shouldn't be a surprise, but it was a surprise for us. Many of the young people at the Ariel Community Academy have had a chance to see me at work, picking stocks, doing research, learning how to pick stocks. Melody Hobson, as co-CEO of Ariel, they've had a chance to observe her and get to know her. So many of these young people decided to have financial services careers. And several have been summer interns with us. Some have worked with us full-time at the firm. One of our graduates started his own company called Rapunzel to help educate people on investing. So getting exposed to financial services careers has been a real benefit of the Ariel Community Academy. And of course, the kids are learning how to pick real stocks with real money, which we think inspires them to do their research thoroughly.
I think there's a lot of questions this year about what role the financial community plays. What role does Wall Street play? And you know, you said earlier this year to one of my colleagues that many black people are really locked out of this economy. So what role, what can Wall Street more specifically be doing to close the racial divide?
I think there's several things. One, when I chaired President Obama's Council for Financial Capability for Young Americans, one of the recommendations we gave the president was that we wanted financial institutions to partner with urban public schools the same way we have at Ariel, where again, kids would learn about the stock market, learn about lucrative financial services careers. The second thing that financial institutions can do a much better job of is working with minority-owned companies, making sure when they're out there, they spend billions and billions of dollars, investment banking services, money management services, advertising and marketing, all kinds of professional fees these major financial institutions spend money on. They really should be spending some of that money with minority-owned companies to be able to create wealth in minority communities throughout our country. We think that's critically important. And then finally, they should ask all the vendors that work with them to have diverse professionals on the relationship with their financial institutions. And that added demand will make sure that a lot of folks will get hired for the first time in segments that interact with the financial services industry.
So you talked about your work with former President Obama, but we have Joe Biden here today announcing a lot of new people in high-level positions, some women, some people of color. But what can they specifically do? What would you like to see them do more immediately to help close the racial divide?
Well, I think one of the things that the federal government can do and President Biden will be able to do is to use the bully pulpit to do the same thing that progressive mayors like Harold Washington did when he was the mayor of Chicago, or Maynard Jackson when he was the mayor of Atlanta, to push hard for the federal government to do business with minority-owned companies in everything we do. You know, the federal government controls the PBGC. They hire lots of money managers. They control the Kennedy Center and the Smithsonian that hires all kinds of folks, the National Railroad Trust. And then if you think about it, the Department of Transportation oversees the airlines, United Airlines, American Airlines, the train companies, and all the rest. Push those companies to do the right thing and do business with minority firms, and you'll be able to create real wealth in our communities. I've seen that work beautifully here at the University of Chicago, where they work with 95 professional services firms, up from roughly 0 12 years ago. It's creating real multi-generational wealth for those minority-owned companies. So the president can really do that, his team can do that, and make a real substantial dent in this wealth divide that's just gotten worse and worse.
And John, just we have a couple seconds really left here, but I do want to ask you, in the middle of this aid negotiation, is there anything very specifically you think that communities really need more immediately?
Well, I think we desperately need to get this stimulus to get people back at work in those small businesses in our local communities, because they provide jobs for people who are out of work today. So I've got my fingers crossed we'll be able to make progress on this important legislative initiative.
Mm-hmm. John, thank you so much for joining us. Thank you for joining us, John. This is Bloomberg.